Hey, what's up, stock compounders? Brad here. So today was a big day, obviously, the Berkshire Hathaway annual meeting. I've just been watching Sven Carlin's recap of that meeting. It's fantastic. Check out this video from Sven. But today we're going to go through another Q&A. And I gave a theme for this week. Q&A theme, what are your biggest obstacles to achieving great long-term performance in your investment portfolio? So that was kind of the theme. I was hoping to get some questions around. So let's dive in to this week's Q&A. First one, Jack Duffley, buddy of mine. We're both on Punch Card Investing. Check it out. It's like a collaborative channel that we're doing with a few other YouTubers as well. Time seems to be the biggest issue for just about everything a person wants to do. How do you prioritize investing and researching over other things in life? Do you have a rigid routine that you follow? Great question, Jack. So I do not have a rigid routine that I follow. I have two very young kids. My son Leo is like 2.5 years old. Natalie is 6 months old. So I have virtually no control over my life. So I just kind of fit in investment research wherever I can get it in. But, it is so much of life, so much of being effective, getting things done, kind of achieving goals in life is about prioritizing one's time. And I find that with such a compression of time, having two small kids, the priorities naturally rise up. I have so little kind of me time in life that I just find myself doing the things that I really want to spend my time doing. But it's not a rigid routine by any means. But I encourage all of you to really figure out for yourselves what are the most important things to do each day. And kind of taking that from a 50,000 foot view, what do I want to achieve in life? What do I want my life to look like? How do I want to impact the world? And work backwards to, okay, what do I need to be doing today in order to get to that place or have that impact? I think that's a really important exercise that a lot of people just overlook. They don't go through that process. I think it's really important for having a life that one can be proud of at the end. So thanks for that question, Jack. Understanding all details of competition and its impact on moat. For Alibaba, for example, understanding Tencent and how WeChat powers competitors like Pinduoduo, JD.com, and taking away part of Alibaba's moat. Understanding the details of competition, it's really just falls into that circle of competence with businesses, right? How well do you understand the business? A big part of understanding the business is understanding the competition, right? A business is never a business in isolation. There's an ecosystem there of businesses, suppliers, customers, employees, and then other businesses that are trying to take that market share as well. So it's really just about having that curiosity about the business and what their competitive position is, the investment thesis over the next 10, 20, 30 years. It's that curiosity, that deep curiosity that's going to drive you or any investor to really spend the time to understand the picture in as full of a sense as we can get. And that curiosity can't be taught, right? It's got to be something that comes kind of from the inside, drives us from within. So, and I like what Charlie Munger and Monish Pabrai say about that. If you're asking, if you're wondering if something is in your circle of competence or if you understand something, you don't, right? Asking the question gives you the answer. Just keep digging, dig. We're never going to have complete understanding of any business or business environment. So it's really up to each of us to decide, okay, when do I know enough to have conviction in this position, or what level of conviction do I have? And that can dictate, how much you allocate into each position. So it's a really interesting puzzle. It's what makes investing such a fun and ever evolving activity. Letting a company compound for me versus selling for a profit and moving into another investment. Yeah, that's a tricky one. It seems like everybody's on a different part of the curve for that. Um, really, what Pabrai says about this: if the business is getting better, right? If you buy into a business because you think it's a solid business and you can buy with a reasonable margin of safety, if the business is getting better, leave your money alone. Trust that management team to grow that capital for you rather than becoming the capital allocator yourself and moving the money around constantly. There's a lot to be said for just finding a great business and sticking with it, even if it seems overvalued at different points in time, right? If the business is getting better, again, look at investing as a business owner, right? We're not necessarily being, driven to make decisions from what the price is doing, from the wiggles of Mr. Market, right? We're investing because we believe in the business, what the business is generating in terms of, earnings over time. So, find a great business, and if it keeps getting better, let it ride. That's kind of where I'm at. If it's getting worse, or if the moat is deteriorating, if the business model is becoming obsolete, then it could very well be time to pull the investment out and find a better place to let it compound and grow. But it's a difficult question for any investor to decide what is that point where, I feel like that capital can be grown somewhere else more effectively. Is this a Monish Pabrai clone where you ask questions in your Q&A? It may be. I like what Pabrai did at Columbia. He's always fielding questions from people, and it was a fun shift to ask those questions. I enjoyed that segment. I have doubts that I will be able to properly do buy and hold for the long term and will be hurt by my overactivity. So that's great. That is great to have that self-awareness about, am I going to be able to do this? It's difficult to sit on your hands. We're really trained, I feel like from an early age, at least in the U.S., that the more we do, the more productive we are, right? More activity leads to more fruits. And that's really not true in the investing realm, at least from a value investing framework. So I'd encourage you to ask yourself, why do I have doubts that I'll be able to buy and hold for the long term? And, are those doubts a product of really not having conviction in the framework, in the value investing framework itself? It may help to study some great value investors and, like Buffett, look at his returns on Geico or Coca-Cola, really understand where the majority of Berkshire Hathaway's returns have come from. Has it been, buying a 20-cent dollar bill and flipping it after 2 or 3 years? Or has it been buying and holding great businesses? So there may just need to be a little bit more work done with case studies of what does it mean to pick an investment that really moves the needle for a fund or an individual's personal portfolio. But that's something I think everyone struggles with. It's human in some ways to think that the more active we are, the faster we're going to get to the promised land, or we're going to generate higher returns by doing more, but it really hasn't panned out that way, based on results that I've seen. John, my biggest challenge will be understanding the right time to take profits. So this is a similar question to a couple ago, especially regarding a high conviction stock. How do you approach this? Again, I'm going to reiterate this. If a business is getting better, by taking profits, so let's back up. So Pabrai really recommended this book, 100 to 1 in the Stock Market, by Phelps, Thomas Phelps. And what Phelps says in that book really impacted Pabrai. He said, whenever you decide to sell, you're admitting to an investing mistake. Okay? This is really coming from the framework of, I want to buy and let the company compound my wealth for me, right? I want to find these 100-bagger stocks, rather than being the kind of active capital allocator myself. So the way I approach it, the way I'm approaching it moving forward, this is kind of a recent transition for me. But I'm not going to take profits if the business is getting better. Because if I take profits, now I have to find another investment that I probably don't understand as well as the one that I've owned for a while. And so there's just more risk there. So if the business is getting better, let that management team, let that business do the compounding for you. Okay? It's really just a simplified approach over buying 50-cent dollar bills. And that's how I'm thinking about it. So one thing I will say, Nick Sleep bought Amazon fairly early on. I think it was like 2005. Nick Sleep's Nomad Investing Partnership bought Amazon. Now, he never sold through 2014 when they liquidated the fund. They returned all that money to investors. And then he continued to hold Amazon until 2018. Now, from 2005 to 2018, Amazon had become 70% of Nick Sleep's net worth. Okay, 70% in one stock. That made it difficult for him to sleep at night, because it was just so large a portion of his net worth. So what he decided to do is sell half of that stake in Amazon. Okay, I think it was like $1,500 per share. It's more than doubled since then. But it was just too big a portion of his net worth to be able to sleep comfortably at night. So that's another consideration. That's one way to take profits. If an investment has grown to such a size that it's uncomfortable for you, it's just more than you're comfortable with, you don't have to sell the whole thing. There's other options. You can sell half and let the other half ride. So, there's multiple ways to approach this. But thanks for that question, John. Nicholas, how do you obtain the confidence to make big bets in the stock market and have high conviction in your ideas and research? It really just, it comes over time. I think it comes with experience. It comes with when you get that perfect pitch that's in your sweet spot, and you just know that the deck is stacked in your favor, massively in your favor for this particular opportunity, and it's at the right price. There's a margin of safety built in. When you've done enough investing, you know that when you see it, and it doesn't come along very often. And all right, it's so rare that I get an opportunity this good. I need to move a lot of chips into this bet. So it's really just experience. It's knowing what you know and what you don't know. Knowing when something is squarely kind of in your wheelhouse. And there's another piece of this too. It's like I like what Pabrai said. If wealth is lost, nothing is lost. If health is lost, something is lost. If character is lost, everything is lost. Okay, so we're really just playing with wealth here. I know it's scary for people, but at the end of the day, you know, it's money. Okay, that's weird hearing that probably from an investing channel on YouTube, but we've got to make smart decisions, but we also shouldn't get so wound up about this stuff. That's my personal take. Finding enough time between university, social life, other interests to research and understand companies. The question is, how much time do you need to allocate for investing and get a good return? Of course, the time is much less when you clone, right? Absolutely. So for me, it's more about how much do you enjoy investing? Okay, how much do you enjoy researching individual companies and doing this kind of concentrated value investing approach to growing your wealth? I mean, there's other options if that's not something you enjoy, if that's not something you want to prioritize with the limited time that you have each day. There's always the magic formula, right? I've done some videos about that, how I kind of run different filters through the magic formula every quarter and buy a basket of 5 so that I have 20 each year. There's indexing, right? The guy William Green, who wrote Richer, Wiser, Happier, which is a fantastic book. I recommend everyone either listen to that on Audible or get the physical book. He doesn't invest in individual stocks, right? He invests in index funds. A guy who knows a lot more than most people about investing, who's spent years hanging out, picking the brains of some of the greatest investors in the world, buys index funds, okay? So, you've really got to just ask yourself, how much time and effort do I want to put into this? And if the answer is not very much, look at the options that don't require much time. Magic formula, coming up with some kind of intelligent cloning approach, index funds, right? So there's really options for anywhere along that scale of how much time you want to spend. Would you consider doing a video on investors to clone that are not super investors and do not run funds with billions in assets under management? For example, Chris Meyer, Elliot Turner, Jeremy Raper, Andrew Rosenblum. Absolutely. This is at the top of my list of things to really get dialed in, is a short list, maybe 10 investors that probably aren't tracked by Dataroma, who are managing less money, and really just dial in on, all right, when are they releasing quarterly letters, if they're doing that, kind of following which stocks they're talking about on Twitter, dialing in, sourcing ideas from smaller investors. So you guys are going to see more content on that moving forward. Thanks for the reminder on that, Oscar. But keep in mind as well, Monish Pabrai runs, I don't know, maybe 500 million, 600 million. And he bought a 20 million market cap company in Turkey, right? So it's possible to, find some great small opportunities from, investors that we see as super investors. So I wouldn't write off the bigger players either. But yeah, I am excited to dive into some of these investors who are managing smaller sums. To find the fair value of a company and what to do when it reaches that value. Do you hold and see, or sell out with the chance of losing out on some extra upside? Yeah, I mean, for this one, so again, I'll go back to Pabrai. When you're looking for 100 baggers, what you're looking for shifts, okay? Valuation becomes less important. You still want to buy with some margin of safety because you might be wrong, right? The company may not have a sustainable competitive advantage, a moat, and you don't want to lose money if you're wrong. So it's nice to have a little cushion. Um, but I mean, valuing a company is tough, right? Valuing a company, the way that I typically do it with a discounted cash flow valuation, involves projecting, earnings, projecting cash flows out into the future, a decade. Who knows what the world is going to look like in a decade? So it's a difficult exercise. Um, it's much easier with some businesses than it is with other businesses. But I mean, if you're looking at small companies, say 500 million market cap or less, it's it's going to be tougher in general than a big company like Facebook or Google or Microsoft. But the question is, do you hold and see or sell out with the chance? So hopefully through owning the company, you'll get to know a little bit about, what kind of competitive advantage it has. Does it have compounding DNA, or is it just a discounted pie, as Pabrai would say? Is it a 50-cent dollar bill? So, hopefully that happens. Hopefully you're able to distinguish between the two after you own the company for a while. And then if you find out it's a discounted pie, and it gets to fair value or close to fair value, might be the time to sell out and move that over to another investment that you get to see, okay, is this a discounted pie or a growing pie? So that's how I look at it. You've got to understand what you have, what you own. And like I said in the past couple comments, if the business is getting better, and you think this could be a long-term compounder, you really forget about the valuation, okay? You're in it for the business. You're not in it for the price wiggles, okay? You're not looking to Mr. Market to tell you what this thing is worth. You know what you've got because you understand the business. So that's what I would say there. How have you set up your lifestyle that is conducive to long-term success in the market? Example, being busy so you are not checking quotes every day. How have I set up my lifestyle? Well, I mean, my lifestyle honestly is largely set up from my kids at this point. I am no longer the master of my time. But, I find pockets to work on things. And I think long-term success in the market is really knowing what to focus on and what to ignore. And, Nick Sleep gets into this in Richer, Wiser, Happier. Zen and the Art of Motorcycle Diaries is a book that really inspired Nick Sleep to really distill down to what is essential, right? And how to do those essential things in the highest quality way. So, part of what I'm aiming to do here is to really learn the core principles of long-term investing. What are the core principles of success for long-term investing? Studying other great investors, really expanding my ability to learn about businesses, right? Understand businesses, break them down. So it's deciding what to spend your time on. And there really aren't that many things that are, there's not a lot of great options in the investing world in terms of what to spend time on. There's only a few things that are worth spending time on. Studying, learning from other great investors, learning how to understand businesses better, market psychology, learning about market psychology, because it's really humans that make up, these crazy fluctuations in the stock market. Hopefully that helps. What percent of your wealth do you have in cash for an event? Or are you all in on investing and don't bother with an emergency fund? There could be damage to your stock compounding rate depending on the option you choose. I think it's wise to have around 6 months at a minimum of cash just for life emergencies, right? 6 months of cash. So you figure out, all right, what do I spend each month just on survival expenses? Having 6 months of that kind of gives a peace of mind, I think. I think that's important. There could be damage to your stock compounding rate depending on the option. Yeah, that's what I would say. 6 months of expenses, I think, is good to have in cash. Let's see. I find it terrifying that all companies eventually die. It's kind of terrifying that all humans die as well. Charlie Munger really likes using biology, learning from biology when it comes to business and investing. I'm not sure how I will notice my businesses dying before Wall Street does and before the price goes down. Don't give Wall Street too much credit. Okay, I think it's natural, especially for newer investors who are just coming in to the craft, to think Wall Street has so much more figured out than we do. Okay, I try to set that aside. I think that might be giving Wall Street too much credit. And before the price goes down, maybe I will just sell when the gurus sell. That's a fine idea. I have no issue with picking a handful of gurus, only buying stocks that are owned by those gurus. And when, the guru that owns that stock sells, maybe it's time to do the same. I don't have an issue with that. I'm also curious what my returns will be after paying long-term capital gains on stocks multiple times as opposed to an index fund where I would only have to pay once. Well, there's nothing saying you can't just hold on to a stock, right? Obviously, that's part of the question. All companies die. But, some companies last 30 years, 50 years, right? Ideally, those are the ones we want to own. Great businesses that are going to compound money over multiple decades, okay? And so you might not have to worry too much about capital gains if you have those companies in your portfolio. Hopefully they continue being great, well into retirement. So that's really a personal question, what your returns will be after paying long-term gains. Based on your personal situation. But yeah, how do you notice if a business is dying, right? Again, you got to understand the business. And, look at revenue growth, look at earnings growth, look at margins, understand the competition. Is the competition doing something innovative in the space that's going to start to steal market share away from your company? But, if you don't want to get into all that, if you don't have the time, if you don't want to devote the time to really understanding the business and the ecosystem that the business is operating in, I don't have a problem, again, outsourcing sell decisions to great investors, okay? Follow the 13 Fs when it's clear that they've sold. Might be time to exit. Hey, I'm 17. Awesome. So glad you're 17 and you're already digging into the realm of investing. I'm very passionate about investing. I've read already more than 10 books about investing. But one thing that bothers me is the research and reading these annual reports. Yes, annual reports can be quite dry. Okay, I will admit that. Most of the junk there I cannot understand, nor do I think I need to understand. I can read financial statements and all that, and it's so demotivating. Okay, I'd much rather just watch analysis from another person. Should I keep reading these boring annual reports of 300 pages or focus more on what analysts have to say to learn about businesses? So, okay, there's quite a bit in here. First of all, if you have a 300-page annual report, there's probably only a dozen, maybe 24 pages in there that matter to the investment thesis. I would say. So you don't need to read the whole thing. Understand the risks of the business. Understand the financials, which it seems you have a grasp of, and what management's vision of the business is moving forward. There's only a few sections that are critical, in my opinion, in the annual reports. Um, and it may be true that you just don't want to spend that much time understanding individual businesses. Uh, so in that case, I mean, there's other approaches, right? There's kind of a creating a rational, intelligent cloner approach. There's the magic formula, like I talked about. There's indexing. So, there's other options if you don't want to spend time reading annual reports. Um, Now, analysts, I wouldn't put too much weight on what analysts are saying, right? Especially if they're paid analysts, like it's their job to be analysts, because often they get compensated um, to sell those companies, right? To sell other investors on those companies. That's kind of what they're paid to do. And you don't want that. That's a conflict of interest. In terms of my interest is, I want to do well owning this business. But the analyst doesn't have any skin in the game owning the business. They collect a salary. So there's incentives that are misaligned there. It's different if you're looking at investors, right? And they're writing letters to their investors and they're talking about different businesses that they own. I would say, there could be a lot of valuable information in there about an investment case. Value Investors Club. Obviously, I've mentioned that before. Those write-ups can be really good. So yeah, it's something you got to feel into and understand. If you're not willing to read annual reports, that might say something about I'm just not that interested in understanding these businesses, maybe as well as I need to in order to do a concentrated value approach in terms of understanding the businesses yourself. So that's important for you to know about yourself. And from there, you can decide, all right, here's how I'm going to structure this because I know I don't want to go down this road. What are my other options aside from indexing? If it sounds like maybe you want to try to outperform more of a passive indexing approach. So it's really, there's no limits to what you can craft for yourself. There's a lot of art in this. It's not just science. So we each need to construct a portfolio approach that's really tailored to who we are and how we operate. So the more you can learn about yourself, the more you know what you want to do, what you don't want to do, the more you can construct an investment approach that's well suited to how you want to relate to investing. So great questions, though. All right, that's it, guys. Thank you for all of the fantastic questions with this week's Q&A. I like this. I think I'm going to continue offering themes each week. It's been fun for me. If any of you have suggestions about future themes for Q&A topics, I'm sure you guys have some great ideas. Let me know in the comments to this video, and I'll try to incorporate some of those themes moving forward. So anyway, guys, thank you all for being here, and I will see you in the next video. Take care.